Welcome back to the second session of our guide to metric accounting. We're going to do a recap. The first thing we've learned is about company registration, how in South Africa companies are registered on a CIPC a portal. And then we've learned about the importance of Companies Act being the regulatory framework that guides on how companies need to be registered, how the appointment of directors, and the appointment of auditors, etc. We've learned about two different types of shares, ordinary shares and preference shares, where the difference is based on voting rights and the dividends. Then we've learned what a shareholder is. We've learned about how accounting for a share capital, what is a share capital and how do we account for it. We've learned the difference between authorized shares and issued shares. We've also learned the difference between dividends that have been declared and paid and dividends that have been paid and the accounting implications thereof. We also learned about director's fees and audit fees. So in this chapter, we're going to cover accounting cycle for companies. We're going to cover income taxes. We're going to cover interest-bearing loans. We're going to cover share buybacks. Right? So what's an accounting cycle? So accounting cycle is just a process flow from the initial recording of the transaction to the transaction being in the financial statements, right? So the accounting cycle doesn't differ for companies and for sole traders or partnership. The only difference is just more on complexity of it, right? For companies, because there is so many transactions, usually companies use what we call accounting systems, such as SEB and others, right? So the process to which a transaction, when it occurs, is being recorded in the financial statement is that's from a journal being processed. So a journal is being processed maybe by a financial controller or by a divisional accountant. Then once it's being processed, the journal is being processed on an accounting system, then the accounting system processes that journal into a general ledger, right? From a general ledger, then it goes to a trial balance. Trial balance, then that's where financial statements are being prepared, right? So in order to elaborate more on the accounting cycle, we're going to cover the examples using income taxes and others that we are going to cover in subsequent lectures, right? So what is a tax, right? So tax is one of those tools that government use to raise funds in order to cover its government expenditures, right? Government expenditure include your education, public health, providing houses, providing social grants, and providing security such as police and defense forces, right? So in order to finance all those activities, it needs money. And one of the tools which money is being raised is tax, right? So where does a tax involves in a company, right? So if you're a company in South Africa and you are registered with CIPC, you are required to pay taxes, right? Then there's a legislation that governs how taxes are being paid and how the tax is being calculated. And that legislation is called the income tax, right? Then the agency or the organization that is responsible to administer or to make sure that everyone that owes is due to pays tax is called South African Revenue Services, also known as SARS, right? So SARS collects the tax that is due on behalf of National Treasury, right? So how companies pay tax is that they have to file a return called ITR 14, right? So this return, they file it on an annual basis. In simplest form, it's just more of saying, this is us, the company, this is how much we've made, this is the tax that is going to be paid to you guys, meaning SARS, right? Then, obviously, companies vary in sizes, right? So there are other companies that are big, there are others that are small, right? So for those ones that are big, most of the time, find out their tax is very high. So in order for to reduce that burden of companies having to pay a significant amount of money, a significant amount of tax at one time, SARS require companies to pay two payments during the financial period of the company. And these two payments are called provisional tax. So the whole aim is that when a return is being submitted and the income tax is determined, the company won't have a huge burden to pay the amount due, as it will be reduced by those two payments. But you'll see more on the examples going forward, right? Then how is this income tax calculated? It's calculated on a fixed rate in South Africa. At the date of this lecture, it was 28%. So it's 28% of profit before tax, right? For the purpose of the syllabus, but there are other complex things around how they determine that profit before tax for tax purposes, right? For example, if company A made a profit before tax of 200,000 for financial period ending 31 December 2021, calculate what is the income tax due. What is going to happen is just because 200,000 times 28%, which is equals to 56,000. Then this is the tax that is due. What general entry is going to be processed, we'll see that in the next slide. So the general going to be processed is going to be debit current tax with 56,000, then credit SARS income tax. This is a liability because the company is obliged to pay this 56,000 to SARS, right? Then your narration is just going to be the income tax due of 20% of the profit, right? So that's the general entry that an accountant is going to process. Then in the general ledger, the accounting system is going to, once the general entry is being processed, the accounting system is going to process this general ledger. It's going to say debit your current tax. In your current tax, it's going to say debit your current tax, and your account that is being debited is going to be SARS current tax, right? Then because of this is a nominal account, meaning current tax is a nominal account, it affects your net profit, then it's going to be taken to net profit. It doesn't have a closing balance, right? Then because of there's what we call a liability that is called SARS income tax. Remember that 56,000 rand, a company needs to pay that money to SARS. So at this point, we haven't given you that the company has paid it. So it's going to say credit 56,000 with a current tax, because in this side we said debit, so this side has to be credit, right? So a balancing figure is going to be balance carried down of 56,000 because of it's not being paid, right? Then your balance brought down is going to be 56,000, right? Then on your trial balance, we expect under your balance sheet section, SARS income tax. This is a liability. That's why it's got a credit balance of 56,000. Then we have a nominal account current tax, which is equal to 56,000. Then trial balance, it balances both sides. Negative, the debit has to be equal to the credit, right? Then in your financial statements, we expect in your statement of profit or loss, you'll have your profit before tax. Remember, the company made a profit of before tax of 200,000, then it paid current tax of 56,000, then that means the profit after tax is 144, right? Then when the user is looking at this financial statement, you'll be able to see that, okay, the company made 200,000, but not all that amount belongs to the company. It's obliged to pay tax to SARS. So that tax to SARS is at 28%, and it's called current tax. So it's 56,000. It means the company is left with 144 that is available and maybe to be distributed to the shareholders, as we've seen previously when we were talking about dividends, right? Then in your statement of financial position, remember you owe SARS 56,000. Then it's a current liability. Why is it current liabilities? Current liabilities are those liabilities that are going to be paid within the next 12 months, right? So obviously, when you determine how much you owe to SARS, you have to pay, you're going to pay to SARS within that 12 months, right? Yeah. Then we move on. We're going to touch on how the provisional tax example works, right? So let's say there's a company A, then it made a profit before tax of 200,000, right? For financial period ending the 20 December 2021, right? Then the company made first provisional payment of 25,000 on 30 June 2021 and made a second provisional tax of 32,000 on 30 December 2021, right? Then they say calculate the current tax for the year. Then you calculate the income tax amount due to SARS, right? So solution is current tax. As we say, current tax is your profit before tax times 28%, which is cost to 56,000. Then the income tax that is due to SARS is cost to your current tax minus your provisional tax plus your second provisional tax payment, right? Your current tax is 56,000. This is how much the current tax that you owe SARS, but so that SARS reduces the burden of you having to pay that current tax as is determined at the end of the year, right? It allows you to pay provisional tax of 25,000 and that of 27,000 that you've paid during the year. Then it means when you determine your current tax, you owe 56,000, but you already paid 25 and 27. Then it means you only owe SARS 4,000. So that's the purpose of provisional tax, is to make sure that when you determine your current tax, you don't have a huge burden in order to that is due to SARS, but you only pay whatever is remaining after subtracting all the payments that you've made throughout the year. Then next up, we're going to cover interest on loans, right? So companies source of funding other than the cash obtained from issue of shares. Remember, in the first lecture, we're talking about issue of shares. This is when the company issues shares to the shareholders in order to raise funds, right? Then the other option is the company raise funds by obtaining loans from financial institutions. Your financial institutions can be your banks, can be your yes, you can be your banks and your bonds market, but these are just complex. For the purpose of this syllabus, you just know there's a financial institution that the company can obtain loans from, right? Then, obviously, when the loan is being obtained by the company will have to agree on a certain interest rate, right? Whereby it says, okay, we've obtained this loan, then we're going to pay this loan plus interest, so that the provider of that loan reduces the risk of the company not being able to pay, right? Then if that's the case, it means if you obtain a loan, it will be your loan plus interest, right? Then the interest increases your loan balance, right? Then the company, based on the loan agreement, can make loan payments monthly or annual basis, right? So your payments obviously is going to include your interest plus your principal payment. Principal payment is how much you've borrowed, right? But we'll see that in example. So we can agree that your loan balance is equal to your amount obtained, right? Your loan amount obtained plus interest expense minus repayments, right? Then the interest expense is recorded in the statement of profit or loss as it is an expense, right? But we'll see much when we do example. Then there's a classification of loans. Yeah? Classification is more of saying in your financial statements, how are you going to classify this loan? Are you classifying it as a current liability or a non-current liability? Remember, we said current liability are those liabilities that are going to be paid within the next 12 months. Then non-current liabilities are those liabilities other than your current liabilities, meaning those that they're going to pay after your 12 months. Then it means if you have a loan under non-current liabilities, you're going to put the loan balance that will be paid after 12 months. 12 months after year end. Remember, financial statement, especially statement of financial position, is prepared at a point in time. At the end of the year, you run a report in your accounting system. It gives you your statement of financial position as at that date, right? Then the non-current liabilities are going to be those loans from that date going forward, right? Then there's current liabilities. Your current liabilities, this is the balance of the loan that will be paid within the next 12 months from the year end, right? So if you know that today is the year end and in the next financial year, I'm going to pay 4,000 rand. It means your current liabilities is going to be that 4,000 rand minus the interest for that year. Remember, we said a payment of a loan is the principal amount plus an interest, but we'll see that when you're going to do an example. Right? So an example is that there's a company A that obtained a loan of 400,000 from ABC Bank on 1 January 2020. Then the loan is repayable over a period of 5 years. The interest on loan is 10% per annum. The loan repayments are 25,000 and made on the 20th December each year. From here, we can see that we have a loan that we've obtained of 100,000 and the loan interest is 10% and the payments are 25,000. Then we are told that provide how the transaction will be recorded in the financial statements of company A for the year ended 31. Right? Then it means on the 1 January, when the loan is being obtained, remember now you are receiving cash in your company. It means it's going to increase your bank. A bank is an asset. An asset increases in the debit side, right? So it's going to be debit bank, credit loan. Why? Because of a loan is a liability. A liability increases on your credit side, right? Then on the 20th December, you calculate your interest. Your interest is 10% of your principal amount, which is 100,000. So it's 10% times 100,000. Then the loan was there for 12 months from 1 January 2021 to the 1 December 2021. Then your interest is 10,000, right? Then from there, you make a payment. When you make a payment, you agree that when you make a payment, cash is going out. Cash affects your bank. A bank is an asset and it decreases where? On your credit side. It means 25,000 is going out, right? Then your liability is a loan. A loan is a liability, right? And a loan decreases where? On the debit side, because of now you are paying back that loan. Yeah. Then on the general ledger, your loan general ledger. And now when you receive your bank 1 January, credit bank, you credit that loan, 1,000 rand, your narration is 10,000. Your narration is bank, 100,000. Then because of, we said your interest expense increases your loan. Remember when you obtain a loan, you obtain a loan of 100,000. But that doesn't mean it's going to pay back 100,000. Just to incur interest. So the interest increases the loan, right? Then it's also increases the other credit side. Then we have like 110. Then you made a payment. Your payment reduces your loan account. Loan account reduces the debit side. Then it's 25,000, right? Then your balance figure is 85,000. Then it means at the 20th December, your loan amount that is due is 85,000, right? Then your interest expense GL is just debit loan of 25,000, right? Then on your bank GL, remember 1 January obtain your bank account increases by 100,000 when you obtain the loan, right? Then only the 20th December you paid the loan 25,000. Then it means you are left with 75,000 balancing factor. Then the bank is 75,000, right? Then on the trial balance, your balance sheet sections, that's where you put your asset and liabilities. Your asset is a bank, 75,000. Your loan is a liability, 85,000. The interest expense is an expense, then it's got a debit side of it, 10,000, then it balances. Right? Then the impact on your financial statements. Impact on your financial statements under operating profit before interest, you'll have interest expense of 25,000 on your profit or loss. Remember, we said interest expense goes to your statement of profit or loss, right? Then on the statement of financial position, we'll just ignore the asset part up there. Then, okay, sorry about that. And remember, we say under your owner's equity and liabilities, you'll have current liabilities. Current liabilities are those ones that are going to pay in the next 12 months from the year end, right? Then we say, from example, we said loan payments are 25,000 each year. right? Then it means this 25,000 is the capital amount plus interest, but it's going to be made in the next year, right? So it means at this point in time, the current loan, the current portion of the loan is going to be 25,000 minus the interest that is going to be incurred in the next year. So that only 16,500 relates to the current portion of the loan, the principal amount of the loan, right? Then your non-current liability is just your closing loan balance minus current portion. Then it's going to 85,000 minus 16,500. Then 16,500, 68,500 plus 16,500 is still your loan account of 85,000, right? So the whole purpose of here was to show you that your current liabilities are those liabilities that are going to be paid for the next 12 months from the year end. We know that in the next year, we're going to pay 25,000 to this loan, right? But not all this 25,000 relates to capital or the loan amount. It also includes interest. So we need to include the next year interest. So that's why we are left with 16,500. But we will also have to show a non-current liabilities, right, of this loan. So the non-current liabilities we say is your closing loan balance, which was 85,000 minus 16,500, right? So I'll stop here, then I'll continue in the next chapter to cover about share buybacks.